Well, I think the market evidently did get a little bit ahead of itself. It seemed to make a big deal out of the Fed Chair Powell's statements about how rates were close to neutral. And the problem with that is just that the Fed said a lot of things over the last couple of years that turned out not to be right. And I think ultimately the market will be driven by data, not by, and then ultimately the Fed's actions will be driven by data, not what the Fed says today about what it's going to do at some point in the future. So I tend to, obviously I don't know exactly what's going to happen. Macro investing is not exactly what I do, but yeah, I do tend to be pretty skeptical that all the turbulence is behind us, and so I wouldn't bet a lot of money on it, but I do. But I would basically expect a double dip is sort of what is probably what I would expect to happen from here.
But maybe you'll bet a little money on it, and a little money for you is a lot of money for a lot of other people. So talk about what your expectations are and what sorts of investments you do make during this period. I mean, I don't know if it's that much different if you're investing at the early stage in technologies and trends that you expect to persist. But what's your focus right now?
Well, the reason why I said this is, I think, last week on our podcast, the All In Pod, that I thought we were headed for a double dip is because, first of all, you have to realize that we are in a technical recession now based on the definition being 2 quarters of negative GDP growth. That was caused by inflation, as we all know. You had a 7 point something percent nominal growth rate. You had a 9% inflation rate. So you subtract those two things and you get to a negative real GDP growth rate. I think it's possible that based on inflation coming down a little bit, that you could see us bounce to positive in Q3 or Q4. But the reason why I think it could be a double dip is because all these interest rate increases that the Fed has now done this year. I guess we've had 4 rate increases, and it's been, including 275-point rate increases being the last 2. Those really haven't worked their way through the economy yet. They've worked their way through the markets, but it takes 6 to 9 months for those types of rate increases to really work their way through the real economy. So I would expect that by next year, you would start to see a real impact on economic activity. And so you already see it now. If you look at what the builders are telling us with new home starts, inventories piling up, that industry tends to be impacted very quickly by rate increases. So this is why I, again, wouldn't necessarily put a lot of money on it, but I do think that a double dip is probably the case I would bet on.